Hello class, this is my financial derivatives project. In this presentation, I will be discussing both mini projects and mini project one. It will be going over a historical financial derivatives company that is very notable. And in the second mini project, I'll go over a simulated trading portfolio of futures and option contracts based on companies and contracts of my choice and reasoning. So as mentioned before, the first part of this project is looking at a notable company that dealt with financial derivatives. The company that I chose to do was a company known as Amaranth Advisors Limited Liability Corporation. I chose the company because it was one that grew extremely fast in terms of the number of assets it managed, and it was one that crashed even faster and ultimately had to liquidate all of its assets and close the company in a very short amount of time. All of the exceptional growth and devastating crash and fall that came from it, from the use of financial derivatives, and yeah, the use of financial derivatives with futures and option contracts. So as mentioned previously in the last slide, the company rose and fell extremely quickly. It was founded in 2000, and then it was done in 2006. And even more notably was how fast and how much it grew in from 2005 2006 and how fast it crashed in literally about a month. So like I said, it was founded in 2000 in Connecticut by a guy named Nicholas M. Maunis. And he established this American multi-strategy hedge fund called Amaranth Advisors LLC. He appointed Brian Hunter to be the primary trader for the fund, and he led all the operations. Before it failed in 2006 in September, at its peak, the business managed assets worth up to 9.2 billion in funds. And then notably, Amaranth Advisors lost over 6 billion on natural gas futures, and it's widely considered one of the worst hedge fund failures in history. And the collapse in 2006 resulted in the largest single trading loss ever recorded at the time. When it was announced in September 2006, the $9.5 billion hedge fund had lost more than 65% of all of its assets that it managed. In the end, they were almost forced to sell all of their energy books to J.P. Morgan, Chase, and Citadel. And then from there, the company liquidated remaining assets, and their trading fund was it was suspended in October of 2006, leading to the end of the company. So literally, almost $9.6 billion in asset from September to October gone. The whole company just disappeared. So it was really notable, and it was widely considered a bad trade, just because of how highly leveraged they were. Yeah. The rise of the company shows how lucrative and profitable the derivatives market can be, especially when you look at energy field futures, such and options, such as how they looked at natural gas. So I mean, it can be extremely lucrative, but at the same time, the collapse of Amaranth Advisors, it's become a vital lesson in emphasizing the significance of smart risk management, diversification, and comprehending overall the complexity of derivatives trading. So what went wrong? You have a company that grew extremely fast, and they're up to almost $10 billion in funds that they're managing. How can something like that grew so fast, how does it crash and burn in a matter of about a month, the whole fund? So there was a lot that went right. There was a lot that went wrong. When I say that, there was a lot that went right, but there's even more that went wrong with this company. And it's why it has become so notable when discussing risk management in the derivatives market. Brian Hunter, who I mentioned previously, he was the lead trader of this fund. And he became very notable and famous for his work in 2005. In 2005, he was listed for all traders. He was listed as one of the top highest paid traders in the world. He took home between 75 million and 125 million just for himself that year. That's what he made in his own commissions. And for the company of Amaranth themselves, he made an excess over $1 billion. He helped Amaranth's assets grow from 6 to 8.7 billion by April of 2006. And almost all of the money and growth for the whole company of Amaranth came from Brian Hunter and his trades. So he became a very popular person, and he was very successful in what he did. And his whole trading concept was extremely, in its nature, it was extremely simple, right? What he did was extremely simple in his idea behind it. And what made him so successful was how highly leveraged he was and how successful he was by these trades. And then essentially, he took that same concept from 2005, 2006, and went all in essentially in 2006. And when things didn't go his way that he planned, that's when things went bad. So who knows if if the market had responded to how he thought he would be, or how he thought it was going to happen, he could have been probably noted as one of the most successful traders ever. So let's talk about his strategy here, and what happened, what went wrong, what he was thinking. So there's a level of seasonality that exists with natural gas futures. And Amaranth employed a derivative strategy known as calendar spreads. So what are calendar spreads? It's just a derivative strategy. There's a concept of buying a longer dated contract to sell a shorter dated contract. In this strategies, investors can enter into both long and short positions on the same underlying asset but at different delivery dates. Brian Hunter used a strategy in that spreads between winter and non-winter months for natural gases would widen, and demand for natural gas tends to be less in summer, which leads to decreased prices. And then the opposite is true, where in winter the demand rises for natural gas and there are higher prices. The hedge funds trades were very simple in concept, like I said. So what would they do with that? They would take a long position in the winter natural gas positions, and then when the summer came around, they would go and take a short position on those natural gas positions. And then due to the correlated nature of natural gas and seasonality, this whole process became heavily lucrative, and the fund was able to grow massively under this trading strategy. Therefore, you could technically engage in futures and option contracts as a result of the correlation between natural gas prices and seasonality. Yet, as we know, correlation doesn't mean causation, and you can't fully say that something that's correlated is going to happen with certainty. Correlation does not mean certainty. So in September 2006, the natural gas market did something that it had never done before, and which resulted in a strategy that Hunter had in place to be devastating. Essentially, it was just better weather. He used more than half of the firm's capital on this calendar spread with the belief that the spread would widen. However, instead of this occurring, the market spread shrank. And then with this market spread shrinking, Amaranth was unable to exit its positions as the trade started to go south. The aggressive trade failed, and it led to the collapse of this fund. Also, what's notable, it wasn't what caused the fund to collapse, but it's very notable. On top of this, Brian Hunter, he also engaged in a practice that was highly prohibited and illegal. It's known as banging the close. So what is that? Banging the close, it's notable because it's a malpractice, and then it puts a lot of scrutiny on you. The whole concept is that if you push enough volume on the trader can push the market in favor for a short time, especially in the case of future and derivatives market. For example, assume there's a huge sell-off of futures contracts at the conclusion of the day, and that the sell-off occurred on the final trading day of the New York Mercantile Exchange, the natural gas futures contract on that. The larger the sell-off in the last few minutes of the trade, the greater the price decline would be. So this is what Hunter would do. He would continually do this, and he would push from his short to long contracts and have his traders, he would specifically tell his traders, hey, don't execute these contracts until the last 8 minutes of the day. So he did this multiple times. In the last 8 minutes of the day, he would unload almost 99% of his long position at the end of the trading day. The trades would all be done. The market would close, and it would manipulate the price of the natural gas. So it became extremely profitable for Hunter. And this late close of him unloading the position is what's the strategy known as banging the close. But again, manipulating the price is highly prohibited and illegal, and it's considered a malpractice in the financial trading industry. So the combination, that's what went wrong. He assumed that correlation meant certainty, and it didn't. And then on top of that, he practiced a malpractice that was illegal. So in the end, what happened? In the end, between the manipulative practice and a highly leveraged position in natural gas prices that saw natural gas prices continue to go down due to good weather, Amaranth as a company had to liquidate their assets and the positions in natural gas. They posted a $6.6 billion loss, and then with the large majority of this loss coming in just 1 month between September and October of 2006. JP Morgan, Chase, and Citadel purchased over 50% of the natural gas assets from Amaranth. And surprisingly, well, not surprisingly, but they're just over leveraged, but these companies that took over their assets proceeded to make a fortune from the collapse. As it was reported that the Citadel and JP Morgan each made over $1 billion just from the acquisitions of Hunter's positions in the natural gas market. So pretty interesting, right? But overall, Amaranth Advisors is a great example of why investors shouldn't be highly leveraged into one deal to make it. There needs to be levels, there needs to be proper levels of risk management and diversification in a portfolio in order to hedge the losses of certain trades not performing as expected. In this industry, there's high opportunities for profit and asset growth in these forward and option contracts, but at the same time, there's high level risk that must be monitored as well. The collapse of this company, Amaranth Advisors, has become a vital lesson in emphasizing the significance of smart risk management, diversification, and also comprehending the complexity of derivatives trading. All right, that's going to wrap up part one, talking about the hedge fund and historical thing. And now we're going to look at a simulating trading portfolio. I chose to look at, my own personal portfolio. I chose to look at both future contracts and option contracts and try to get commodities and companies that were all in different sectors and businesses in order to set up a diverse portfolio. As we talked about previously, what happened with Amaranth is that they were highly leveraged and they were almost putting all their eggs in one basket. You can't do that in trading, no matter how certain you can be, because at the same time, things can happen that aren't expected. So in mine, I tried to make mine as diverse as I could. It's very basic, but try to make it diverse with a few future contracts and option contracts that I had. So the simulated $100,000 that I had was either invested in the companies that I was familiar with or ones that I thought would be interesting and that would be a good investment opportunity. Like I said, the portfolio included commodities, it included financials, retail businesses, and technology. The goal of the portfolio obviously was to make a profit, but it was also to not be over leveraged into one asset or sector in case of something that happened that would be detrimental to the portfolio. So what did I want to invest in? I took a little bit, but I decided to look at things that I was familiar with and that I could have an opinion on about how they would perform in the market. And so here's what my portfolio consisted of. I looked at both oats and gold future contracts, and then I looked at option contracts for U.S. Bank, Lululemon, Visa, Chipotle. Again, companies and commodities in different sectors for diversification. I took a long position in oats futures. I took this under the assumption of seasonal demand. I looked at oats as just being like an agricultural thing, so I could have looked at any futures contract with an agricultural item. So that's how I looked at it when I picked it. And the whole idea was that there would be a higher demand for agricultural commodities in the springtime as farmers they plant in the spring months, and as a result, there's an increased demand in the oat futures as the farmers and producers try to lock in a price. Same concept. Oats are used to feed livestock, and the demand for meats is higher during the summer months with people being outside grilling. So there would be a coinciding demand that goes up in oats, so there would be in meats. The idea is that the oats price would go up, so we should take a long position and benefit from that. Kind of similar idea, not really, but I took a long position with my gold futures. I mean, same idea in the sense that I think the price is going to go up. But my ideology with gold and my logic with gold was that gold's something that's always stored value. Just always has. That's why I think like the gold standard used to exist that monitor the amount of cash there'll be in the business or in the bank. And with the current state of the U.S. economy, there's been a lot of inflation over the past few years. So something that can hold value like gold would have its price increase on the market because people value that as it holds its own value. So I took a long position because I felt that people would still want to invest in gold and hold gold for the fact that inflation is happening. Now into the companies and my option contracts. I took a call option for U.S. Bank with the idea that financial institutions and their stock price would increase due to economic growth in the United States. Economic growth, expansion, it can lead to an increase in demand for loans, mortgages, and other financial services, which would in turn lead to an increase in the demand for stock price of U.S. Bank. Also, as mentioned, inflation, but also interest rates in the United States have been on the rise, and the company would benefit from this as it can charge a higher level of interest on all of their loans as a give out, and in turn, it can result in more increased revenue. Now, Lululemon, it's not something that I have, but I picked this company solely. I've never purchased anything from them myself. I picked this company solely because my mom, my sister, my girlfriend, and really a lot of people around my age, they love this company. I chose to do it as a call option because it's just a company that is extremely popular, and it continues to grow. Me personally, I don't understand it because I just feel like everything is overpriced. I know they have good customer service and their quality is nice, but to me, it just feels like their athleisure items, as they market it, are just overpriced. But in saying that, there's no denying its growth and popularity. So I took a call position because I saw no reason why the company's stock price would decline. So why would you take a put position? A put position, you're betting on the company's stock price decline, and that's how you make your money. I'm betting on the stock price to go up and call options so I can make a profit on that. So yeah, I took a call option on Lululemon because I just think it's going to be a successful company and it's going to continue to grow. Now on to Visa. Okay, so I was thinking about Visa and U.S. Bank as they're pretty similar with how they operate. They're both kind of financial institutions, right? So the reason I did it is because they're both involved with the economy. Visa, they're like an electronic company that helps do finances from bank to institution to like a restaurant, for example. And so I thought from the same logic, I thought it'd be very similar with the economy of the United States. However, so you think I do a call option, right? Because there's a way that the stock option would increase. I took a put option on this because I wasn't exactly sure on my reasoning behind U.S. Bank and why the option would increase. So, I mean, in a portfolio, it's good to hedge your risk and be diversified. I took this as a direct diversification off of my logic of U.S. Bank. So I did a put option on Visa because I was like, well, if I'm wrong there, Visa will correct it, right? And that'll hedge it. To my surprise, I'm going to talk about this in the next slide, but so I took the U.S. Bank call option and the Visa put option, and both ended up making money. So my logic was a little wrong on each. The stock price of Visa decreased, and I made a profit from that, and the stock price for U.S. Bank increased, made a profit on that. And the final company I looked at was Chipotle. Chipotle is a company I love. I love their food. It's something that I've always eaten. It's just such an easy thing for me. and it's typically pretty healthy. And on top of it, it's a company that is popular and continue to grow. So what do you think I do? I take a call option, right? No, actually, I took a put option because recently there's been a lot of concern with Chipotle about their food concerns with E. coli, for example. They've had an issue with salmonella in the past, among other things. And it's been pretty notable for how many times it's occurred. Um, and on top of this, like ever since COVID, their food prices have increased at an astounding rate. Like it is not exactly cheap at all anymore to just go get a burrito for lunch. Like it's over $10. Where back in the day you go get a chicken burrito, you get everything on it, and it'd be maybe $6. I mean that's just how things change. I know inflation is a real thing, but Chipotle has continually increased their prices, and for me, it's very noticeable because I ate there all the time. I've ate there a lot less, just for that reason. So, like when I look at the food aspect of it and the health reasoning, and on top of it, the fact that their prices are increasing so much, I would think that it'd be not as popular, even though it's a company that's continued to grow. So I took a put option just because I was curious. Like you'd think the stock price would decline with that. And then for those reasons, I decided to do a put option because I believe the stock would go down and I could profit from that. And yeah, those are the companies I looked at, and that's like the reasoning behind what I did. So let's look at how my portfolio performed over the course of this class. So based on my investment reasoning from the previous video, here are my results based on the different strategies for each positions based on these different economic factors. So my different reasoning for each resulted in a net profit on the fund just over $12,000. I'm really only just going to talk about some of the notable and interesting things I found. For the most part, my reasoning behind the different decisions has been true as it relates to the stock price. So I'm not going to talk about really like, oh, the gold held its value and it increased, so I was right about that. I want to talk about the ones that are a little interesting in terms of advanced logic. So the oats future, you can see the total gain was $5. So you didn't really gain, we broke even. So was my logic a little different? It's hard to say, right? Or if is that something that we have to look at a call or we have to look at a long position over a longer period of time? Did I just exit out too early? Because I mean these long positions could have been taken over a longer period of time, right? So that part's interesting. It essentially just broke even on that, right? And again, this is what I want to talk about again. The U.S. Bank and Visa. It's an interesting one to note because my logic behind doing a call and a put option behind U.S. Bank and Visa was a hedge. I simply did it as a hedge because I wasn't sure about if my logic was right. But the call option for U.S. Bank was profitable. It was actually my most profitable gain. I gained over $9,000 on it, which is extremely notable. I mean, I did take 80 contracts out, but that was just because of the price of the stock. But a $9,000 gain. And then Visa was profitable as well with a put option. So I'm not sure where my logic was or what was wrong there, but what happened in the market. But I do think it's very interesting, right? And then obviously the one in red, the one that was noticeable was the $5,000 loss on the put option of Chipotle. The stock price continued to grow. Shows people still believe in investing in Chipotle and consuming the food despite the food concerns and increasing prices that I assumed. I mean, it's not that surprising. I just figured it could have been an impact. Chipotle is a very successful company. It's continuing to grow. It's one of the top food chains for that fast leisure food. So yeah, it was super interesting. Overall, I thought this was a pretty interesting project. It was fun to learn about derivatives in this class. I thought learning about hedge funds that have crashed and grow were super interesting. And then doing this myself, doing like a simulated portfolio was super interesting as well. And obviously you can see how with the zero sum nature, futures contracts and call options and put options, how you can be extremely profitable, but it's also very risky too, and you could be take significant losses as well. Yeah, that's it. Thank you.